What is a term sheet? Have you ever wondered what a term sheet is and how it can impact your business startup funding? Let's break it down in simple terms. A term sheet is a written document that outlines the key terms and conditions of a proposed financial deal or investment. It serves as a preliminary agreement between parties before any final legal contracts are created. This document summarizes the main points of the transaction. It includes details like the amount of funding, valuation, ownership structure, and rights of the involved parties. However, it is important to note that a term sheet is generally non-binding. This means it does not create a legal obligation until definitive agreements are signed. When it comes to banks and credit unions, especially in the context of business startup funding, a term sheet plays a vital role in the loan or investment process. When a business seeks financing, the bank or credit union issues a term sheet to the borrower. This document details the proposed loan terms, including the loan amount, interest rate, repayment schedule, collateral requirements, and any fees involved. Understanding the term sheet helps the borrower grasp the financing offer. It also signals the lender's commitment to proceed with underwriting the loan, but this is subject to credit approval and due diligence. Key features of a term sheet relevant to banks and credit unions include the loan terms. This means clear specifications of the principal amount, interest rate, repayment period, and payment frequency. Another important aspect is collateral and security. This describes the assets pledged as security for the loan, which reduces the lender's risk. Additionally, there are covenants. These are conditions the borrower must meet during the loan term, such as maintaining certain financial ratios or providing regular financial reports. Fees and expenses are also outlined in the term sheet. This includes any origination fees, closing costs, or other charges associated with the loan. Lastly, conditions precedent are requirements that must be satisfied before the loan is finalized. This could involve verification of business financials or legal documentation. For startups and new businesses, receiving a term sheet from a bank or credit union is often the first formal step toward securing funding. It provides transparency about the financing offer and allows the business owner to evaluate whether the terms align with their financial goals and business plan. Once the term sheet is signed, the lender moves forward with an internal credit review and underwriting to finalize the loan approval. A term sheet is a foundational document that outlines the essential terms of a financing arrangement between a bank or credit union and a business borrower. It helps both parties clarify expectations and sets the stage for the detailed loan agreements that follow. This makes it an important tool in managing business, startup funds, and achieving financial goals.